The $50 stock that reported record profit was already going broke. On the page, its net income climbed clean every quarter. In the ledger, its operating cash had crashed towards zero. That gap between profit and cash on the chart is the tell. The earnings quality X-ray catches the fraud before the crash. Net income is an opinion. Only cash saves you from going broke. A company can fake profit, but the missing cash spells bankruptcy. The check that exposes the lie takes barely 10 minutes. You need 2 numbers, 5 years, and 1 subtraction. Net income up top, operating cash right beneath on the page. Line them up and watch the red gap on the chart widen. A steady gap is normal. A widening one warns of collapse. Today you learn to read that gap the way Buffett does. Here is the whole method, and it fits on one page. Step 1, pull 5 years of the reported net income. You find it on the income statement, the bottom line. Write those 5 numbers in one row across the page. Step 2, pull 5 years of cash from operations. You find it on the cash flow statement near the top. Write those numbers directly beneath the first in the ledger. Step 3 is the whole trick, and it is subtraction. Each year, subtract the cash from the net income on the page. That difference is the accrual gap penciled year by year. In an honest company, that gap on the chart stays small. Cash can even run above profit. That firm won't go broke. That happens when a business collects gold before it spends. The gap that widens every year is how investors get ruined. Profit climbs while the red cash line falls and warns you. That divergence means the profit exists only on the page. Real earnings become real gold within a year or two. Earnings that never become cash leave investors broke. The X-ray turns an invisible fraud into a bright red line. Now let me show you the 3 ways the gap is faked. The first trick is channel stuffing, an old Wall Street game. You ship goods nobody ordered and book them as sales. Net income jumps, yet no real cash comes before the crash. The unpaid bills pile up until the whole thing collapses. The second trick is capitalizing ordinary running costs. You bury today's expenses on the balance sheet as assets. Profit looks fatter because the cost vanished from the page, but the cash still left through the door and it shows. The third trick pulls tomorrow's revenue onto today's page. You drag future sales forward to flatter this one quarter. Every trick inflates profit while the cash quietly collapses. That refusal of cash is the fraud's own red fingerprint. The company that proved this was Sunbeam back in 1996. Its board hired Al Dunlap, the man they called Chainsaw. He was famous for gutting firms until the workers went broke. The move that thrilled Wall Street was firing in bulk. He cut 12,000 jobs almost overnight. The stock nearly tripled as Wall Street cheered the profit. The profit that Dunlap reported was mostly pure fiction. Sunbeam stuffed dealers with grills nobody bought and it blew up. They shipped grills to dealers and booked it on the page. Grills meant for July were shipped and billed in March. Net income soared while the real business was going broke. But operating cash had crashed sharply negative in red. The gap that exposed Sunbeam sat right there on the page. Reported profit said plus $109 million for the year. Cash from operations said minus $60 million in red. That is a gap that leaves honest-looking firms bankrupt. One analyst, Andrew Shaw, ran exactly this simple check. The number that gave it away sat red in the receivables. Receivables had grown far faster than the sales on the chart. It meant fake sales, and buyers lost the cash for good. Andrew Shaw downgraded the stock while the crowd cheered. The warning that saved careful investors came a year early. Sunbeam's paper profit hid a business quietly going broke. In 1998, the fraud unraveled and the stock collapsed. It crashed from $52 a share to under $1. The company that dazzled Wall Street simply went bankrupt. Shareholders who ignored that red gap were wiped out. Al Dunlap was barred from running a public company again. The X-ray that anyone could run had flashed red for years. You did not need inside information, only the page. You needed only 2 numbers and the nerve to subtract. The fraud that fooled the headlines never fooled the cash. Cash is the one gold number management cannot invent. Every accrual game eventually meets a cash statement, and that statement keeps a stubborn count in the ledger. That stubborn count is exactly what the X-ray reads for you. Now run the same X-ray on a clean, honest ledger. Take Coca-Cola, a company Buffett has held for decades. Line up its net income across 5 straight years, then line its operating cash right beneath on the page. Year after year, the cash beats profit and never crashes. That is the opposite of Sunbeam's widening red wound. Coca-Cola collects your dollar before it pays its costs, so cash arrives early and the profit is backed in gold. The gap that would worry you never appears on the chart. The X-ray does not only catch fraud, it confirms quality. A widening gap warns you, a tight page reassures you. That is why Buffett trusts cash over reported earnings. He wants the profit to land as real gold in the bank. A business that turns profit into gold can compound for decades. One that cannot will eventually collapse under its own debt. The clean compounder passes the X-ray for 5 straight years. The fraud fails and its stock crashes before the news breaks. Same numbers, same subtraction. One compounds, one is wiped out. That single red gap separates the compounder from the ruined. You now hold the test that reads both in 10 minutes. Let me tell you why this check on the page is powerful. Fraud hides in the ledger's parts that need human judgment. Misjudge when to book a sale and the profit turns worthless. Cash from operations strips that judgment off the page. It asks one blunt question: did the gold actually move? That blunt question is very hard to lie to in the ledger, so the gap on the chart is the lie's own long shadow. Watch that red shadow over 5 years, not one loud quarter. One bad year can be timing, 5 straight is a pattern. A widening pattern means the profit is worthless paper, but do not read every red gap as instant proof of fraud. A fast-growing firm can burn gold building new inventory. So read the gap with the story, never in blind panic. Ask where the cash went, then judge the page you find. The X-ray points the flashlight. Your judgment does the rest. The 5-year gap that widens has ruined 1,000 investors. So, here is the 10-minute X-ray from start to finish. 1. Write 5 years of net income in a single row. 2. Write 5 years of cash from operations below it. 3. Subtract and watch the red gap on the chart. A small, steady gap means the earnings will not crash. Cash above profit is the mark of a true gold compounder. A gap that widens every year is your signal to run. That signal caught Sunbeam a year before the 1998 collapse, and it confirmed Coca-Cola quarter after steady quarter. 2 numbers on the page told fraud from compounder. It all comes from Graham and Buffett's own writing. The books that teach this are linked below in the description. You can listen to them free with the Audible trial link. They turn this one page into an entire analyst's toolkit. Earnings quality is the first X-ray. Debt can bankrupt anyone. The next X-ray reads, debt in red. The one after, the moat. Each one is 2 or 3 numbers and a subtraction. String them together and read any ledger like Buffett. That is the whole promise here, one real skill, daily. If this method helped, subscribe so you never miss one. A fresh value tool lands on this page every day. You are building an analyst's eye, one red gap at a time. The fraud that you catch next could wipe out your own account. So run the X-ray before you trust any reported profit. Net income is a story, cash is the gold truth. Learn the gap, and no fake can ever wipe you out. You now hold a check that the crowd refuses to run. Keep it on one page and use it every earnings season. Tomorrow, the formula that tells you exactly how much to bet and why Buffett once bet 40%.